Welcome to another chapter having to do with internal control, subsidiary ledgers, and specialized journals. The focus of chapter 10 is on the cash receipts journal. You will hear me refer to it as the CRJ, and the cash payments journal, abbreviated as CPJ. Recall in previous chapters that we discussed the importance of internal control, and this is also an attempt to improve efficiency. So, what exactly are we supposed to do with each of these specialized journals? Well, first of all, let's remind ourselves of the subsidiary ledgers. There is the accounts receivable ledger, which is comprised of the individual accounts of each customer or the individual account of customers. And this usually used by firms with a large customer base. And of course, you have the accounts payable ledger, which contains the individual accounts of each supplier, the accounts of each supplier. The sum of the balance in the accounts receivable ledger must match the balance in the control account called accounts receivable. And that control account is in the general ledger. Same thing is true for the accounts payable subsidiary ledger. The sum of the balances in this ledger, subsidiary ledger, must match the control account balance of the business that you would find in the general ledger called accounts payable. So each of these subsidiary ledgers has a control account in the general ledger. The general ledger, you may remember, is the ledger that has all the accounts that comprise a firm's chart of accounts. Then we have, of course, the general ledger, which, as I said, contains all the accounts made up of the business's chart of accounts. I'll show you an example of a chart of account related to the show me problem, and you can also find that illustrated in your textbook. There are four major specialized journals. So you have the general journal, which is the main journal. Then you have these specialized journals, and they do specific things. And once you have these specialized journals, the general journal, as a rule, will fill in the gaps. So the cash receipts journal records all cash receipts, which means then that you should not see a cash receipts recorded in the general journal. But notice it records all cash receipts, regardless of the source of the cash. The total in your cash receipts journal is debited to the cash account in the general ledger. So we are not changing the way that we record cash receipts. You would still debit cash and credit whomever it is that gave the cash. However, instead of making multiple entries in the cash account, we would have the multiple entries in the cash receipts journal and then periodic totals, whether it be daily or weekly, as the case may be, to the cash account in the general ledger. Same thing is true for the cash payments journal or CPJ. This one records all cash payments. So the cash payments journal is really the credit column, if you will, of the cash account, because the total from this subsidiary or this specialized journal is recorded on the credit side of the firm's cash account. So all cash payments, regardless of what we are paying for, will be recorded in the cash payments journal. And again, if we are using this specialized journal, then it means that we would not be recording cash payments in the general journal. That will be a duplication, and this is not when we would want redundancy. That would create confusion. Then we have the purchases journal and the sales journal. These two were focused on in chapter 9. Purchases journal is used to record the purchase of merchandise inventory. And so it's most likely that if you are a service firm, you would not need a purchases journal. And recall that the way your purchases journal columns are labeled, specifically the column for the debit for inventory, will be titled purchases if you're using the periodic inventory method, and would be titled inventory if you were using the perpetual inventory method. Again, the total purchases for the period is going to be debited to purchases if you're using the periodic, or to inventory if you are using the perpetual, and the credit goes to accounts payable. Appreciate that the individual amounts would be credited to the account of each of the suppliers. The sales journal is used to record the sale of merchandise inventory on credit. Notice cash sales would not be in the sales journal. Those would be in the cash receipts journal. But the sales journal is used to record the sale of merchandise on credit. The total sale is going to be recorded just like you would any other sale by crediting your sales account, and you would debit the total amount to the accounts receivable in the general ledger. Of course, the individual amounts would be debited to the account of each customer. So you can see that we're not changing the way that we record transactions. We are simply trying to make it easier to get to the information by categorizing. With computers, to be very candid, these specialized journals, if they are used, would not be as often as they were before, because we can easily record things and automatically have them entered in the appropriate accounts. But it's important to appreciate that there is efficiency, especially for a manual system, if you understand how these specialized journals are used. Here is a sample cash receipts journal, and again, the specific title for the columns will be dependent on how the firm wants to use this cash receipts journal. What will not be different though is the cash debit column, because remember, the cash receipts journal is supposed to record all cash receipts. So for example, here is a cash sale, and the person probably paid us by using a debit card, and so they paid us the sum of these two, 480 plus 20. So they paid us $500, but we are only going to get $20 because the bank or the credit card company is going to take out $20 for the credit card expense. So if this is a cash sale, then the total sale would be a credit for $500. However, you can see that the cash receipt would be for the difference between the total sale and what it is that we have to pay the credit card company. At the end of the period, or I should say periodically, the total from here, this is usually on a daily basis because you want, for example, to keep your customers' record up to date. And so you don't want to have a situation where a customer sent you cash or sent in a payment and they call in to verify that their account was updated, and you will say, we don't know because we haven't recorded it. So this would usually be on a daily basis. Regardless of the frequency, the accounting will be the same. That is, the total from the cash receipts journal, the total in the cash column will be debited to the cash account. And in this case, if we had a credit card discount or expense account, that would be debited. So you have debit and debit. And then if you have any sales discount, that of course would also be a debit. Recall that with a sales discount, you're giving the customer a reduction on the amount that they have to pay. So they owe us, let's say, $3,500. However, they are allowed to get a discount, looks like about 2%. And so they would pay us 98%, and we would record the discount for the $70. But the amount that would be credited to the customer's account would be the total of 3,500. And so total from this debit is debited to cash. This would go as a debit to your credit card expense. This would go as a debit to sales discount, and the total in this column would be recorded as a credit to accounts receivable. Understand that for each customer, the individual amount would be credited. A similar situation applies for the cash payments journal. Again, the specific titles will be different depending on how the company decides to monitor their cash payments, but what will be common in all situations is the cash credit column, because when you make a payment, that's a give, and so we would credit cash. And so the cash payments journal records all payments regardless of what it is that we are paying for. And so you can see here that they have a cash credit column. They have a column for purchase discounts, which would be a credit. So this would be where they made a purchase and they're getting a discount. And then you have your accounts payable. So if we are recording a purchase on credit, then of course we would um, record, if we're making a payment, sorry, and we're getting a discount, then we would record the discount here. And you can see that we would debit accounts payable with the full amount, but the actual amount that would come out of cash would be the amount net of the purchase discount. So we are paying the customer, sorry, the supplier, $2,600.25, but we are entitled to a $50 discount, and so the check would be for $2,550 and 25 cents. And you can see here again the same thing would apply for these other payments. If we are making a payment to a supplier, then of course we would make the entry in the accounts payable column, but you can see they have other accounts, and this would tell us what the other account would be. So for example, here it's a prepaid expense. So they don't want to create a column for every single item, but they will then have to debit, as the case might be, to each of these accounts, and of course the credit will go to the cash payments column. At the end of the period, the total from here will be credited to cash. If we have purchase discounts, that will be credited, and then each of these columns we will debit as indicated. This is problem 10.1b, which is similar to the one that would have been assigned to you from chapter 10. But take a look before we get into what the problem requires to see an example of a chart of accounts. And you can see that this particular chart of account, all assets begin with number the number 1. And then if it is a current asset, the second digit will be a 1. However, if it is a fixed asset, then or non-current asset, then the second digit would be a 2. This is how the accounting system, the numbering system for this company would work. It's common for companies to have account numbers with multiple digits. Maybe a one digit represents a department, another digit represents a region, so on and so forth. But in this case, it's a fairly simple numbering system. The first digit, if it's a 1, tells you that it's an asset. If the second digit is a 2, then it tells you that it's a non-current asset. And then, of course, the third digit would be driven by the number of accounts in that particular category. So let's say they had furniture, which is also a fixed asset. Maybe that will be 1, 2, 2. Same thing here. You notice that the cash is 111. Well, if they had a petty cash, maybe that would be 112. And then accounts receivable, we have just one accounts receivable because this is our control account. But in the subsidiary ledger for our customers, we can have multiple accounts. And of course, each customer's account is going to have its own unique account number. Then we move from the assets to the liabilities. A similar system is used here. The second digit, the first digit, sorry, tells us that this is a liability. And so it starts with a 2. So any account beginning with a 2 is a liability. However, the second digit, if it's a 1, is indicating that it's a current liability. However, if it's a 2, then it would indicate a non-current liability. Similarly, for equity, it starts with the number 3. And you can see the numbering system there. For revenue, if it begins with a 4, you can see that it would be a revenue account. And of course, the numbering system goes accordingly. Then here, we can tell that this company uses the periodic inventory method because they have a purchases account. So yes, all companies with inventory will have an inventory account, but if they use the periodic method to record the purchase of inventory, then they'll have a purchases account. So this one is in the category of a 5, and these are inventory related accounts. So they all begin with a 5. So you have your purchases, you have your purchase returns, you have your purchase discounts, and you have your freight in. So all of these are related to the inventory. And as you know, if you take the beginning balance in the inventory, add purchases, deduct the returns, deduct the discounts, add the freight, and then subtract, that will give you goods available for sale. And then if you subtract the unsold, the ending inventory, that would give you cost of goods sold. The same result would be achieved if we close out each of these accounts. The entries would be to the cost of goods sold, and the net is going to be the cost of goods sold for that particular period. The last category here are the expenses, the operating expenses. So these are going to result in expenses as well, but they have a different starting number because they are directly related to inventory. Then you have your operating expenses, and each one begins with a 6 for this particular company. So I just wanted to show you or maybe emphasize the numbering system for the chart of account. Each company will have their own approach, but there will be a logical application in terms of how they determine the number for each account. Now, this particular problem appears to be quite lengthy, but if you take it step by step, it's not as tedious as it may seem. Plus, the spreadsheet will help you along the way. If this were an automated environment, it would have been done very quickly. But the first thing we have to do is to record the transactions in the general journal for the month of January. If you are using, so that's what we're going to do because we are using the Excel template to record our transactions. Once we're done with that, it says we should post daily all entries involving customers' accounts to the accounts receivable ledger. So this particular company, their policy, which is a good policy, is to update their customers' accounts on a daily basis. Then we're going to post daily to the accounts payable because again we want to keep our suppliers account updated. If a supplier calls to say we haven't received your payment, we should be able to tell them whether or not the payment was sent. Just like with our customers, we should be able to tell whether the payment was received. And then we have to post daily the general journal entries to the general ledger. So you can see they're using the general ledger. All companies will do that, but they also have the specialized ledgers or the subsidiary ledgers, I should say, one for their customers, which is accounts receivable, and one for their suppliers, which is accounts payable, which means, as you know by now, that in the general ledger you have the control accounts, which you can see here. This is the control account for the accounts receivable subsidiary ledger, and this would be the control account for the accounts payable subsidiary ledger. Most of these transactions are self-explanatory, so I would encourage you to go through each one and verify how it was recorded. But let's just take a few to illustrate. First one is on January 2nd, they issued we have a receipt for 698 to this company, and it's for merchandise, sorry, for the month rent, and it's for $850. And so the check is check number 6981, and we're making it payable, or it was made payable to this entity. And I said made payable because the person recording the transactions would not be the one to write the check, right? That's proper internal control. But how do we record that? Well, if you go into the general journal, what we would do is debit rent expense. And you can see the account number derived from the chart of accounts. We debit for 850 because that was a get. And we decrease our cash, which is account number 111, by the same amount because that was a give. And you would go through like that for each of the transactions. So the transactions themselves are not difficult. They're ones that you have seen before. So I'm just going to highlight a few things. Notice that because we are using the periodic inventory method, purchases are debited to purchases account. If it were the perpetual, then first of all, we would have to use the inventory account and there wouldn't be a purchases account in the chart of accounts, but they're using the periodic, so we did not have to be told that they were using the periodic. By virtue of the purchases account being listed in the chart of accounts, we know that that is the method that they're using. So we debit the purchases, and we credit the accounts payable with the amount. Again, if they are using the purchases journal, then this would have been in that journal and it would not be in the general journal. Regardless, this amount is also going to be credited to this particular supplier's account in the accounts payable ledger. And they say they do this on a daily basis. Then there is another sale. Sorry, this is a collection of receivables. I'm going based on the entries, but you can actually read the transactions. So here we are collecting money from our customers. And so this would have gone in the cash receipts journal. We would have debited the cash receipts, the cash column with the $980. We would have debited the sales discount column with $20, and the accounts receivable would be credited for 1,000. They're not using a cash receipts journal, so everything is flowing through the general journal. So we debit cash, debit the sales discount, and we credit the full amount to the customer's account. So notice, even though we're giving the customer a discount, the full amount is credited. And of course, we split the amount they actually paid us from the discount. And so the sum of the cash received plus the discount is equal to the total amount that would be credited or applied against the balance owed by the customer. Again, just go through each of these. Here is another transaction. This involves a sale. Because they are using the periodic, we do not have any adjusting entry that we need to make. We simply debit accounts receivable in the general ledger as well as in the account for this customer. We debit 755 and sales would be credited for 755. So again, you can go through each of these and see what the transaction was and why it was recorded the way it is. This is the cash account in the general ledger, and you can see that it has quite a few debits and credits. If we were using the cash receipts journal, then we would have far fewer entries, because if they're doing this daily, then we would have had one debit for the second, and all of these, well, there's only one debit for the fourth, and so on and so forth. But if they had multiple, for example, here on the credit side, you see they had multiple credits. If they were using the cash payments journal, all of these that occurred on that particular day would have been just one credit for the total. So the use of the specialized journal would minimize the number of entries in the cash account. But it doesn't change the fact that when you make a payment, that's a decrease or a give, a credit to cash. And when you have a get or a receipt, it's a debit to your cash account. So these are all the accounts in the general ledger. Here's my accounts receivable. This is my control account. So this balance here, which I highlighted, when I look in my accounts receivable subsidiary ledger, the sum of the individual balances must be equal to this number at the end of January. Then we would have recorded the merchandise inventory. Notice at this point there is nothing recorded in the inventory account except the beginning balance, because we're using the periodic. And so until we get to the end of the period, this account will show that we simply have 20,000 plus dollars worth of inventory, which of course is most likely inaccurate. These are just the additional accounts in the general ledger. Notice that the number or check mark in the post reference column indicates that we have in fact recorded the transaction coming from another source. And so here we have for accounts payable the total for that particular day coming from that. If we had our subsidiary account, so at the end of the period, this balance here, which is in the accounts payable in the general ledger, which is my control account, must equal the balance in the sum of the balances in the accounts payable subsidiary ledger. Again, I'm not going through every single page of the worksheet, but I jumped over to the accounts receivable subsidiary ledger, and you can see that this is where we have the individual account for the customers. And so this is the account for a particular customer, and you can see that the amount that was sold to that customer is debited, and so this is the balance. Then we have, here's one where we had a beginning balance of 755. Oh, no, that's wrong. That was an actual sale that was made. Try to find one where we had a beginning balance. Okay, here is one with a beginning balance. We received a payment. They paid off the amount that they owed from the previous month, and then we sold them additional amounts, so this is what they owe us. And so you would continue with that for the all of the customers. In the accounts payable subsidiary ledger, we have a similar situation. This is where we have the account for each of our suppliers. Again, the individual amount that we purchase from a given supplier will be credited to that particular supplier's account. You can see here if there's a debit, that's because we made a payment to that particular supplier. Here's another one, we made a payment. Here's another one, it's a debit, so we made a payment. In fact, we paid off the balance on that particular account. Now we are looking at the trial balance. This is the unadjusted trial balance, which is a listing of all the balances from the general ledger. Do not pull anything from your subsidiary ledger accounts to put into the general ledger. And so these are only from our general ledger, the balances. So you can see this is from the cash account, this is from accounts receivable, and so on. This balance here in accounts receivable should match on this particular date the sum of the balances in the accounts receivable subsidiary ledger. Similarly, accounts payable 3,848.54. That balance should equal the sum of the credit balances in the accounts payable subsidiary ledger. And like all trial balances, if we made the entries correctly, debit equal credit, then your total debit should equal your total credit. Let me end with the subsidiary ledgers. You can see here the schedule on accounts receivable. This is simply taking the balance from each of the accounts in the subsidiary ledger and listing them. And this number here must match, must be equal to the ending balance in the accounts receivable account. If it's not, we have a problem. It needs to be resolved. It could be a clerical error, but there is an error, mathematical error, whatever the case might be, it needs to be resolved. And that's the control feature of the subsidiary ledger and the control account in the general ledger. Similarly, we do a schedule of the accounts payable. We take each supplier that has a credit balance and we add them and we get a net. By the way, Even if you have a supplier for some reason with a debit balance, it goes here, but it would be a negative, and the net should still be equal. If you see a supplier with a debit balance, then you would investigate because it probably means that we overpaid or we paid too much, we paid twice. Similarly, if you see a customer listed with a credit balance, you would want to investigate because it probably means that they paid too much on their account or some other problem that needs to be resolved. Or maybe they're prepaying in anticipation of making an additional purchase from us, but the normal balance should be a debit for each of your customers, and the normal balance should be a credit for each of your suppliers. I hope that this show me problem that you will go through will help you in your completion of problem 10.1a from your textbook.